This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The least sexy, least trendy, and in the eyes of some, least attractive pockets of the market are in gear, while tech and growth stocks increasingly suck wind. But investor sentiment is fickle. Don't be surprised if the market narrative continues to twist and turn as the year draws on. Up next, let's discuss this churn and how important it is to keep your discipline. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton back with you, Managing Director at the Wise Investor Group of Raymond James. Happy Valentine's to you and yours. Nothing says Valentine's, and I love you more than sharing our Wise Investor Group podcast. I say that in jest, but please, we're trying to actively increase our listenership. We put a lot of work into these things every week. Please share it with the people you care about, your friends, your family, your significant others. That would be, I think, a benefit to them if I don't mind, saying so myself, but also, of course, good for us and our exposure in the area. So thank you for that. It was funny. I was sitting at home the other night. It was probably midnight. My wife had long since gone to bed, and I was flipping through the channels, came across that old screwball comedy from the 80s, Revenge of the Nerds. Remember that one? That was a favorite of mine when I was a teenager. Well, isn't that kind of what's going on in the market right now? The leadership is not in the sexy AI stocks at this point. It's the old nerds, right? Chemical companies, freight companies, railroads, energy companies. The least sexy parts of the market are in gear, are in leadership mode. I want to talk a little bit about that over the course of the next 40 minutes or so. But in the meantime, Dow hit 50,000, right? That was a milestone that people thought would be way off. And of course, here it is. We hit 40,000 in May of 2024. So we only needed 21 months to climb another 10,000 points. That's the fastest 10,000 point milestone in history by my math. Should investors fear such milestones? Well, history suggests no. According to Larry Adams here at Raymond James, in the 12 months after previous 10,000 milestones, the Dow delivered an average gain of 17% and was positive every time. Now, of course, I'm not making any market predictions, but I will tell you what I've told you for several months. Success tends to, breed success more than it doesn't. So in other words, that idea that what goes up has to come down, not necessarily the case when you have this type of market momentum. So just keep that in mind. I think that's a positive as we think about the big picture. And by the way, speaking of kind of duration and length of bull markets, Morningstar put out a nice piece this week about kind of the two myths that are still circulating. One is that this rally we've had has been unusually strong, and Morningstar pushes back on that. They looked at the 11 expansions, which they define as the period after which the market reattains a previous high, okay? So they looked at the 11 expansions since 1926. The average has lasted 69 months, a median of 56 months, the longest more than a dozen years. Shortest was 12 months. That was November of 06 through October of 07, right before the financial crisis. Market had tripled its value on average, 224% average cumulative return. Okay, so against that backdrop, current expansion doesn't look unusually long or strong. I mean, as of the end of last year, it was in only its 25th month, a little bit less than half of the average. Okay, and the market's 21.4% per year return over the last 25 months, basically in line with what we've seen historically. Even if you were to measure this bull market from the low of the prior decline, which was December of 22, we're up 93% since then. Still nothing all that amazing from a historical perspective. So this idea that we've had a massive rally, that we've had that is long in the tooth, really not borne out historically if you compare it to other periods. So I just wanted to mention that. Again, I'm not in the prediction business, but those people out there saying, oh, this has to end at some point. Well, it doesn't. History says it doesn't. Doesn't mean we can't have corrections along the way. Doesn't mean we can't have drawdowns. That's a feature of every bull market I've ever been a part of. But To say that we have to peter out here, in 2026, history says that does not have to be the case. But there are a couple things I wanted to get into before I kind of get into the current environment. When I've been thinking a lot about some of the speculative activity in the market over the course of the last year and how a lot of that has significantly waned just here in 2026. I saw a statistic the other day, the Medallion Fund, which was a hedge fund that arguably the best performance of all time, run by a guy named Jim Simons. It's long since closed. The Medallion Fund returned something like 66% a year for 30 years. I mean, like insane returns. But what caught my attention this week, one of the lead traders was quoted saying, "We were only right on 50.75% of our trades." 50.75%. And they returned 66% a year for 30 years. So two takeaways from that. One is you're going to have losers in your portfolio. You're not going to be right all the time. If you have a 30 stock portfolio, regardless of whether you're a trader or a buy and hold investor, you're not going to bat 1,000. You're not going to have 30 names that all do well. Okay? And you shouldn't even be striving for that, because you should be striving for sector diversification, asset class diversification, and know that going in. The second thing is, well, if the best hedge fund of all time is only right about half the time, what about the average guy, sitting in his underwear in the basement, trading online with no experience, just trying to ride momentum? I'd say he's right a lot less than 50% of the time. I mention this because retail trading, i.e. individual investors, has gone through the roof. Retail traders are becoming a larger player in individual stocks, options, you name it. I saw some data from FactSet. Daily retail trading flows last year were roughly 30% higher than they were in 2024. That's a gargantuan increase. So when you have huge moves in things like silver, right? We've seen that. Certainly individual stocks, often meme stocks, but stocks in general. A lot of that is not hedge funds. It's not mutual funds. It's not even people like us, professional financial advisors. It's individual investors trading. I think crypto is a good kind of referendum on that. Cryptocurrencies have definitely been something that have been largely retail owned in many ways, right? Well, crypto is down over 50% over the course of the last year, down under $70,000, right? And I think that the type of swing that we've seen there is very much a reflection on the whims of individual traders. So just the follow-up to that, as you know, if you've listened to me for a long time, I'm a big believer and student of, behavioral finance. I've said for a long time that over long periods of time, the market will be driven by fundamentals, right? Earnings, sales, corporate fundamentals. But over shorter periods of time, markets are driven by sentiment, the whims of investors. And there are a few things just to look out for. And I say this, it's important we all look at ourselves in the mirror from time to time and make sure that we're not succumbing to some of these behavioral temptations, if you will, that can lead to investing mistakes. So I just thought I'd hit on a few of those. One is availability. This is the mental shortcut where we judge something not based on the weight of the evidence, but by how prominent and frequent it is. So, for example, when an asset class keeps hitting new highs, let's say it's stocks, we conflate the volume of evidence with the strength of the evidence, meaning there may be a lot of articles, right? A lot of headlines, but they're all saying the same thing. There are not independent reasons for us to believe that performance will continue. The second is stories. As humans, we understand the world through stories. How many times have I said that price leads narrative? In other words, an asset class will move, silver will move, stocks will move, bonds will move, or an individual stock will move. The headlines are written after the fact, not before the fact. The headlines are written to justify it. So we treat these stories not just as explanations as to why something has occurred, but as a prediction of its persistence. Okay, that can be a big problem, thinking that just because something has happened in the markets, it's likely to have some legs going forward. And related to that is extrapolation, right? combined with sort of recency bias. The combination of high-profile performance and persuasive stories inevitably leads to extrapolation, right? The idea that what's happening today is going to persist into the future. And then, of course, the one that we all hear about all the time, the fear of missing out. I got a lot of calls about Bitcoin fourth quarter of last year. Why are we not in Bitcoin? And I have nothing to say about the merits of Bitcoin, by the way. I'm not saying it should be higher or lower than where it is today. I'm just making a point. I haven't gotten a single call, not a single call this year about cryptocurrencies. And we have a lot of households. I work with a lot of clients. Not a single call. Because there's no fear of missing out anymore. Okay, so again, I'm not here to criticize anybody. I'm certainly susceptible to a lot of these behavioral temptations myself with respect to investing. I just thought I'd mention some of these because the combination of more individuals dominating trading volume combined with the fallibility of humans can be a toxic combination. And that's why when you're looking at the market and you see exaggerated moves in stock prices on a day-to-day basis or whole sector prices, it's not always justified by a fundamental reason. It might just be that the sentiment has changed on something very quickly. It could be fickle and change back a week from now. My suggestion is don't get caught up into it, okay? Don't become susceptible to that. Believe me, there are times to trade. There are times to buy, of course, and there are times to sell, of course. But you try to manage this thing on a day-to-day basis or explain stock price movements on a day-to-day basis, you're going to end up unsuccessful, I think, most of the time. And the antidotes to this are not only, there are three, right? One's patience. That's the advantage, actually, you have as an individual investor. You don't have to mark your portfolio on a daily basis. You're not running a hedge fund. You're not running an endowment with a quarterly board review, right? You can afford to ride out short-term volatility. Two, the second antidote is diversification. Sounds kind of obvious. I talk about it all the time. But the point I've made many times is if everything is doing well in your portfolio at the same time, you're probably doing something wrong. Now, it sounds weird, but it means that if conditions change, everything could be doing poorly, right? I go back to that 30-stock portfolio example. If you have all 30 stocks doing well, I know, listen, if the S&P's up 10%, you might have all 30 stocks up. But on any given day, if you have different sectors, different asset classes, different industry groups, you don't want everything up at one time. Because if the whims change and if the market's favoring a different type of style or sector or industry or whatever it is, 2 weeks from now, you're going to have everything in the red. Diversify. And not just from a portfolio perspective, diversify your life. Diversify your income stream, the time horizon for your investments. I read the example of people who bet on variable rate mortgages because they were certain that rates would drop, and then rates went up. So diversify all aspects of your financial life and your professional life. This is why I always argue about being very careful buying a lot of your own company stock, because your investment performance and your salary, your livelihood are all tied up in one entity, right? And the other thing I would just say is there's this kind of idea of that you need to optimize your portfolio. You know that Carly Simon line, right? You're where you should be all the time. I'm dating myself. That was one of my mom's favorite songs. But you don't need to be where you should be all the time, right? Because again, that goes back to that idea of everything's working at once. Everything may not be working under the same conditions. Be more concerned with wealth management, adhering to the bogeys in your financial plan, than trying to outperform, a certain benchmark. And that's not to say that we're not trying to perform well for our clients or you shouldn't be trying to perform well, but I'd be much more concerned if our financial plans were calling for 6% returns and we were putting up minus 6% returns than if the S&P's up 20 and we're only up 17 or 15 or 14. Be concerned with private wealth management. That's what counts. And optimization means that you're trying to pick kind of when those inflection points will be, when small stocks will start outperforming large or vice versa, right? Stay away from that. It's a fool's errand. All right, I'll leave it at that. Let's talk a little bit about the current lay of the land. I mentioned at the top, it's been revenge of the nerds, right? Look at what is in gear right now. It's machinery, chemicals, industrials, trucks, railroads, right? A lot of the what I would call old economy type names. There are obviously exceptions to this, but tech and AI certainly nowhere close to being in leadership mode, and in many cases in a bear market. And it's funny, I got 2 calls last week from clients, both of which asked the question, are we in a bear market? Well, on the face of it, it's a ridiculous comment, right? Because the S&P 500 is within 1% of its all-time high, okay? But it feels like we're in a bear market if you are overly leveraged to AI and tech. So if you have a $100,000 portfolio and you're 70, 80, 90, 100% tech, you're in a bear market, most likely. Most likely, because a lot of the big tech names are in the midst, not all of them, but a lot of them are in the midst of 20% plus drawdowns. So we're not in a bear market, but what has happened, of course, is we've had significant rotation into a lot of these other areas. And if you look at a lot of the broader indices, like the Value Line Arithmetic Index, the New York Stock Exchange Composite, equal weight S&P, which is all 500 stocks equally weighted instead of market cap weighted, they are all very close, if not at all-time highs. Okay, so rotation continues. I saw something from Dow Jones Research the other day that looked at December 31st, 2024 through November 3rd of last year, okay? And 88% of the S&P 500 return, almost 90% of the S&P 500 return came from the top 100 names. Flash forward to November 3rd through last week, only 12% of the return is coming from the top 100. Okay? So that's pretty darn clear, right? We've started to see leadership broaden out significantly. The Mag 7 names, we've all heard of the Magnificent 7 names. They've had a negative return so far this year and a negative return going back to the end of October. So it's been about 3.5 months of significant rotation. Okay. Remember last week's show? It was called Bizarro World, where everything that was working 2 years ago is not working today, right? So kind of what's going on? I mean, hard to say, right? I mean, some of it is a reflection of just tech was overowned, right? AI was overowned, and the bar was so high that even great news from a lot of the big tech behemoths over the course of the last few weeks as they've reported earnings has not been enough to move the stocks. I mentioned before, some industries like energy, for example, were contributing half the weight to the S&P that they were 5 years ago, which is often a referendum on a very unloved, undervalued sector that maybe has the potential to do better, right? Some of it's that, and some of it's disruption. That's been sort of the theme of the last 2 or 3 weeks. It seems like every day, literally every day, I'm not exaggerating, every day there is a different industry group that is getting slaughtered because of the fear that AI is going to cannibalize profits. Just this week, one day it was real estate stocks, then it was financial services stocks, then it was insurance brokers was another day, and of course legal software in general, where there's been this fear that AI would replace a lot of the legacy software associated with those industries or cannibalize the existing profit structure of those industries. And so maybe what could be going on with some of this rotation also is that, well, railroads, you're not going to disrupt railroads too much with AI, right? I mean, somebody's still got to carry coal and cars and what have you. And in fact, AI might make them more efficient. So there's some industries that will benefit from AI, right, in terms of productivity, efficiencies, and some that are being disrupted altogether. I bring this up because I think the market felt originally, maybe last year, that this disruption would take place over the course of months, years maybe. Well, the fear is it's going to happen in a much shorter period of time, and the market's not waiting around for it. The market is voting now, and I think in some cases the market is overreacting, but that's what's happening. But it's fueling this rotation as well. So again, if you're looking at, I have over 200 stocks on my screen. It's uncanny. Thursday, all the defense contractors were down big because of the fear of some AI disruption. There's also some fundamental underpinning for some of this rotation in the sense that the equal weighted profit margins. So equal weighted profit margins are starting to climb. So what does that mean? Well, we've talked a lot about how profit margin are very, very close to their all-time high level, which has been a big catalyst for corporate earnings, of course, and S&P 500 performance. Well, of course, the S&P is market cap weighted, so that's mostly benefited the large tech names. But the equal weighted S&P, of course, like I said a few minutes ago, is all 500 stocks weighted equally. That margin level is starting to increase as well, which is suggesting that margin improvement is starting to filter into the rails and machinery companies and chemicals, some of these other areas. And that's not really baked into expectations, if you look at, earnings forecasts for this year. So that could potentially be, again, the market's reacting to that now, but that could be the potential for the continuance, the sustainability of this rotation if there's fundamental backing for it, right? If we see higher profit margins, higher earnings, from those types of companies. I would also say, I've been reading anecdotally, there was a guy over at Sparkline Capital, who I'm not familiar with, but I am familiar with Sparkline. He kind of screened all the earnings calls that have taken place over the course of the last few weeks in reference to fourth quarter earnings reports, okay? And he analyzed all the mentions of AI adoption, and I won't get into all the specifics, but he found that in all kinds of industries, everything from consumer marketing to medical clinics to storage unit staffing, weapons manufacturing, a broad swath of the U.S. economy, AI mentions of adoption and by extension, bottom line productivity improvement have escalated at a pretty significant rate just over the course of the last 12 months. More companies across more industries are reporting AI wins. So why is this important? Well, it's important that AI is progressing so quickly. You're going to have the disruptive effects, as I mentioned, but you have to have an open mind, I think, about a scenario where AI is not some speculative bubble that pops, right? That companies do start to see the return on investment, the bottom line improvement that not only fuels the stocks of these other industries, but also augurs for potentially, tech stocks starting to do better again at some point. Because again, I would argue that tech has come under a lot of pressure because of the fear that these spending levels are not sustainable, right? Well, what if that's not the case? What if we're going to continue to spend at this level for some time? I will also tell you that technology multiples, valuation multiples, are getting into extreme territory. Okay? They have fallen significantly. According to Strategas, the tech sector multiples have fallen from about 28 times to less than 23 times earnings in less than 2 months. That's a magnitude of compression more typical of a broad market sell-off, like a 15 to 20% market correction. So for example, in 2022, when the S&P was down 20%, multiples declined from 27 times to 18 times. Tariff meltdown last year, Liberation Day, 27 times to 21 times. So again, we're getting to a point where the expectations for tech have been significantly reduced at a time where maybe there's some signs that we're not in so much of an AI bubble. So we'll see how things play out. I'm very hesitant to predict how everything is going to unfold with how new of a technology this is and how quickly things are changing. But it would not surprise me if we're seeing this big rotation out of tech, but at some point later this year, we go back the other way. Just to give you an example, I'm not picking on Walmart. I don't follow Walmart closely. They're trading at 39 times forward earnings. That's higher than Apple, Google, Amazon, Microsoft, NVIDIA, and Meta, according to FactSet data. Well, at some point do people say, well, wait a second. Why am I paying much more for Walmart, which is growing in the low single digits, than a Google or a Meta or someone like that might be growing in the teens? That's not the conversation today, but could be the conversation. So what did I say at the very top of the show? Let's keep our discipline. Let's not get too sucked up into the narrative du jour. Let's keep balance because things can shift from day to day, not just between value and growth and old economy and new economy, but from industry group to industry group. I'll also just mention one last thing on valuation. We all know how Europe had a good year last year for the first time in a long time, many years, and that's continued so far here in 2026. Well, what's interesting about Europe is Larry Adams at Raymond James noted it this week, is that Europe's outperformance has not been supported by an increase in earnings. It has been supported by an increase in multiples. People are paying more for European stocks than they did a year ago. Meanwhile, here in the U.S., as I mentioned, and it's not just tech, it's the S&P as a whole, people are actually paying less for earnings than they did a year ago. So that's not to say that you should fade Europe and buy U.S. It's just saying that if the sentiment begins to grow that somehow U.S. isn't the place to be, or more specifically that large tech isn't the place to be, that may set up for actually better performance from those areas later in the year. Again, keep your balance because you don't know when those inflection points are going to happen. Lastly, on a market note, guess what's coming up in November? Midterm elections. I've been saying for some time that the midterm election year, if you go back 100 years, is far and away the most volatile year of a 4-year presidential cycle. Okay? And often punctuated by a double-digit drawdown at some point, between January and early November when the elections happen. Okay, so some of this volatility that we're seeing, rotation that I've been talking about, some of it might have to do with politics too. Might be part of it. On the bright side, the S&P 500, according to Strategas, has not declined in the 12 months following a midterm election since 1938. So even if we do get volatility this year, which we've already started to see, and even if it does accelerate at some point into a correction or drawdown of some magnitude, probably we'll see how things go, but it's probably a reason to hang in there, given the prognosis for maybe better markets the year after. So I don't want to get too much into that at this point, but that could be another kind of fueling factor, if you will, for some of this rotation that we're seeing. Up next, stick with me. I have another 10 plus minutes. I want to focus on a few earnings reports that I found interesting over the course of the last few weeks. Stick with me. Back in a sec. Private wealth management goes way beyond picking stocks. Do you have a well-thought-out, cohesive strategy to grow, preserve, and pass along your wealth? Tune in every week as we discuss how to think about your big plans and how to become a better-informed, wise investor. Listen to us at The Wise Investor Group at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Just wanted to highlight a few earnings reports that I spent some time going through and I found interesting. Remember, as I always say, when it comes to individual names, if you're a client of ours, I think you can feel pretty comfortable. We've done our due diligence and feel they're appropriate for your portfolio. If you're not a client, please make sure you do your own research. Make sure they work for your particular situation. The names I mention are names that we own in a number of client portfolios, and I also yes, I do. I own all of these personally in my own account, so you can consider that a conflict of interest. So wanted to mention Google, now known as Alphabet. You know, Google's been one of only two quote-unquote magnificent seven names, NVIDIA being the other, that have actually outperformed the S&P over the course of the last year. It was kind of tough for Google going into earnings because they had been up 30% since the last earnings report, the third quarter report, and something like, I think, almost 60% over the prior 12 months. So the bar was very high for Google. But even with that, the numbers from Google, I think you could say objectively, were very impressive, very impressive. And I think what the numbers essentially shown, and I'll get to the numbers in a second, are a couple things. One is that there's a moat around their footprint that few of any can replicate. You know, one of the things they've talked about is, in their words, is owning the full stack. In other words, not having to be reliant on other companies for really any part of their business. That's not to say they don't have agreements and deals with other companies, but they're not reliant on anybody. So they have vertically integrated approach where they have their own data centers, their own chips, their own software, their own frontier models, and obviously it's starting to show that that's very attractive to their customers. And that's been the kind of the story behind Google, that they've really been able to leverage that. And specifically, we're seeing a couple things. You know, one is their cloud revenue business for the fourth quarter was up 48% year over year. This is according to FactSet, 48%. Meanwhile, some of their competitors have seen some slowing in that part of the business. Their search business, remember, one of the knocks on Google a year ago was that AI was going to cannibalize their search business. It's been the opposite. The AI tools that they have, Gemini and others, are enhancing that search. Their search business was up 17% year over year, and the advertising related to that up 14% year over year. So we're seeing a lot of enthusiasm around their most recent AI program that is, again, accentuating, complementing their existing search business. That's been the big shift for Google over the course of the last 12 months. I was also pretty impressed with the fact that they added, in terms of customers, they added more billion-dollar deals last year than in the prior 3 years combined. And they also announced a $200 billion backlog of business. So essentially, you know, they can't even fulfill all the orders that they have at this point. So when they raised their capital expenditure budget way above what analysts had modeled for, and by the way, the analysts at Deutsche Bank did a good piece on this, I want to give them credit. The initial reaction was, oh no, they're overspending. But Google comes out and says, wait a second, we're doing this just to meet demand. We have the orders for this. We're just trying to make sure that we can deliver. So, you know, within that context, I mean, you can understand why they're ramping up the spending. The other thing that's amazing about Google is the efficiency and the margins that they're doing at this. So I mentioned their Google Cloud revenues were up 48% over the last year. According to Deutsche Bank, 56.4 cents of every new dollar of revenue flowed directly to operating income. And that's astounding. Almost $6 billion in new revenue generated over $3 billion in net operating income. I mean, that's an unbelievable translation. And again, it's hard to imagine that Google isn't going to be a major player going forward and continue to be a major player going forward. What are the risk factors? Well, the risk factors are that, you know, certainly the valuation has gone up over the course of the last year. So I mentioned at the top that the bar is very high for Google. They're not trading at 16, 17 times earnings like they were a year ago. They're in the mid-20s. That's one thing. And the other thing is just the competitive landscape. I mean, the technology is evolving so quickly that we still don't know. I mean, it looks like Google is going to be a keeper, but we don't know like what new disruptive technologies are going to come out 6 months from now, a year from now, that may make Google more attractive, more competitive, or less competitive and attractive. So that's the risk, and that's why you still need to diversify and I think own multiple names in the whole AI ecosystem. Also wanted to mention Uber. The stock has done very poorly recently. It had gone up over $100 a share, back down close to 70. I've said before that Uber may be the cheapest stock in the S&P 500 for not only a company of their size, but a company of their size putting up the type of revenue and earnings growth that they are. And I still think that's the case. Again, Deutsche Bank, I'm quoting them twice here, but they have a good analyst over there who's been following Uber pretty closely. They liked the quarter, despite the fact that stock has sold off since their quarterly numbers. They thought that, particularly when you see the numbers from Lyft and some of the other companies, record ridership, definitely a lot of momentum on sort of the top line, no signs that anybody's taking less Uber rides. Their food delivery business has also seen incredible numbers. I noticed how I saw something the other day, how 3 out of 4 restaurant orders now are being sent to somebody's house. Only 1 out of 4 eaten at the restaurant. So that trend is here to stay. The company is trading, if you look at valuation, they're trading at less than 12 times 2027 EBITDA versus 18% compound annual growth rate of their bookings and 25% compounded annual growth rate of EBITDA over the forecasted, at least, over the 25 to 27 period. So they're trading at a significant, like 40, 50% discount to their growth rates at this time. Okay? Now, that gives the company itself, the CFO of Uber, I think some pretty significant flexibility. I mean, with the stock pulling back this much, the Deutsche Bank analyst noted this week, actually, that they might do something to really take advantage of that, because what they've been doing is kind of sacrificing some profitability in order to grow the top line, but they could easily take some of that free cash flow, maybe buy back some stock. In other words, they have the flexibility to do some things on the bottom line. Right now, they haven't worried about that as much. It reminds me of Amazon a number of years ago where they didn't really care about making money. They were just trying to grow market share. And Uber, it's not exactly like that, but they've been a little bit like that. You may see the CFO saying, okay, enough's enough. It's $70 a share. We've got to do something to drive the bottom line. I think the thing about Uber is the market fears some disruption there, right? We all know that Tesla and others have really come into that space in a pretty significant way. I think the Uber management would argue that that's okay. They were hardware agnostic. It's our platform that matters, and they've formed agreements with all kinds of, car companies and other platforms, software platforms. That's probably why the stock is where it is, that the market fears disruption in that space, that their autonomous driving business will be cannibalized at some point, or at least maybe the profit structure will not be as strong as it is now with more entrants coming into a number of U.S. cities. We'll see. But I would argue the stock price already reflects that. So take a look at Uber. It's really an amazing dislocation between growth and valuation. And if some of this disruption isn't as severe as what the market apparently believes, could be some value there. But it will be a bumpy ride, no question about that. Also just wanted to mention Vistra, V-I-S-T-R-A. You may not know the name, but they're basically a utility, but they operate a large, diversified thermal and nuclear generation fleet that has a lot of leverage to the data center space. So what I've really noted about Vistra is their stock price really doesn't have a whole lot to do with their own operations. It has much more to do with the daily ebbs and flows of sentiment around AI and AI spending because of that kind of connection, the electrification of data centers. But I think the real story with Vistra is the stock has pulled back over the course of the last couple months. symbol is VST, by the way. Goldman Sachs analyst this week noted that they just upgraded their rating on Vistra because they noted it was now trading at a discount, a pretty significant discount to the average fuel price that they've been getting over the course of the last year. They also struck an exclusive deal with Meta, formerly known as Facebook, recently, and they think that they'll get the rest of their capacity sold to other hyperscalers, sooner rather than later. So they think the stock was unfairly punished. So if you're looking for something that benefits from sort of the energy side of AI in terms of lack of energy capacity and incredible energy demand, the picks and shovels around the AI build-out, Vistra was a hot stock last year. It has come down more than 30% from its 52-week high. So maybe something to look at. The risks are kind of obvious that it's such a volatile sector. The sentiment around AI and whether AI is in a bubble changes on an hour-to-hour basis. That's really the risk there. But it's kind of hard to believe that we're not going to be in an environment where there's more demand for energy. And Vistra is pretty well positioned for that. Last thing I just wanted to mention, I wanted to shift gears. Eli Lilly came out with their earnings, and I think their earnings were significant because at least one of their major competitors came out with, for lack of a better word, lousy earnings just a week earlier, and their competitor's name, the competitor was hit like 16%. Eli Lilly came out and basically beat on the bottom line, beat on the top line. We all know that pricing is coming down in sort of the obesity space, the GLP space. But Lilly, according to their numbers that we saw from FactSet, they're making up for it with incredible volume growth. So they should see 40+% year-over-year volume growth in 2026. That's pretty unbelievable. Some of the analysts that I read, including the Goldman Sachs analyst and the Raymond James analyst, they think there's room to beat that. Some of the big catalysts going forward is the number of government-insured obese patients, right? The fat people, essentially. Hey, let's just call it what it is. But there are over 40 million U.S. government-insured obese patients that they have not serviced, that they have not tapped into. Currently, they only have about 2.2 million patients on Zepbound, which is their primary anti-obesity drug. So Goldman Sachs and others think there's a 38 million patient addressable market that theoretically will have more access to their drug with lower prices. So there's a huge volume opportunity there. And from a competitive standpoint, the analysts feel that Eli Lilly's in a really good position. They also have picked up a lot of market share outside the United States in basically cash buyers of obesity prescriptions. So those are much higher margin patients, obviously, where you're not dealing with subsidies or any sort of controlled pricing. So that is another huge opportunity for Eli Lilly. So the risk there would be, that the price has spiked up some over the course of the last few months, so it probably reflects a decent amount of this outlook. And of course, the competitive nature of that business, there are a lot of drug companies that are in that space and coming into that space. There's also the kind of the policy risk, the whims of, President Trump and Kennedy Jr. and what have you in terms of, how they think about obesity drugs. But Eli Lilly does appear to be well-positioned there, and they have the potential probably to outperform some of the current estimates. So I think it's a reasonable name to own in the pharmaceutical/healthcare space, even at an elevated valuation. So those are just a few reports. There are others that maybe I'll get to next time, but those are a few reports that stood out to me. As I said when I started this, if you're not a client, please make sure you do your own homework. Make sure it's right for your portfolio, and consider the fact that we own it here for clients and that I own it personally and how that's a conflict of interest. I hope that was helpful. Enjoy the rest of your Valentine's Day weekend and of course, President's Day weekend. Enjoy it, and until next time, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.